Welcome back to the Watch List, live from the NASDAQ market site here in New York City. I'm Sean Cruz in for Nicole. Here's what's still ahead in the second half. With just 2.5 hours left in today's trading session, the Dow is down to about where we got here, 2,100 points. The NASDAQ, S&P 500 both down 8.5%. But to discuss all this, let's bring in Jeff Small, President, Arbor Financial Group, to discuss the market sell-off. Jeff, thanks a lot for coming on.
Hey, thank you for having me today.
So I definitely think it would be interesting to hear your take on where we're at right now in this sell-off. And if you're sitting there as an investor, seeing the headlines come through, you're asking yourself, should I be concerned? Is this maybe a good opportunity for me to go out there and try and start buying up this market? What are you just generally seeing from the market overall and where we're at right now in this pullback?
Well, the market's repricing on three bases right now. It's repricing on the fact that it's trying to figure out what earnings are going to be like as a result of the slowdown in the economy. And then it's also repricing some panicked and distressed selling. There's lots of panic and distressed selling right now. But the third thing is the most important thing, I think, for investors and for advisors that we have to address. And that is the market's potentially repricing in a federally mandated government shutdown, as most states and a lot of different municipalities and counties have shut down businesses and schools in anticipation of a much larger shutdown as the virus progresses. And so there's lots of issues out there with the markets. I mean, stocks look really good with a 50% correction in them right now with most of them. So, but the telltale sign is, those stocks will buoy back up once we see the virus get under control, if that happens. But if the news keeps being negative, then we're going to see continued sell-offs on the market, and we're potentially going to have a full reversion to the mean, which puts the S&P back down to 1,500 or less.
And I think it is an interesting thought exercise to go through as an investor, and that is stocks are forward-looking, they discount future expectations. So right now, do you think stocks are pricing in a solid slowdown just in GDP growth, we'll say to 1%? Do you think they're pricing in a recession, or they're not yet, and that's where there's more downside to come? And then at what point do you think they'll start looking past the coronavirus and maybe start pricing in some sort of a return to growth?
Well, I think they're repricing a pandemic right now, and that's why we have all of these distressed issues going on. But if the federal government mandates a nationwide shutdown, commerce is going to completely stop. Then we're not looking at a recession, we're looking at a potential depression, and it'll take us at least 2 years to reignite the inertia of the economy. It'll take stocks years to recover what their losses are, because they're not just going to recapture overnight. The best case scenario, though, if that doesn't happen, is that we get a hold of this virus and we mitigate it through social mitigation, and it starts to slow down, and then life gets back to normal, and society and governments go back to more of an acceptance of the fact that this virus is here, it's not going anywhere. But the outlier in all of this is what's happening in Europe. Europe is a forecast of what could potentially happen here, with Italy being completely locked down and cases still exploding, and it looks like Germany, France, and Spain are the next countries to go on lockdown because they're in the several thousand range of infections, which means they're just, a week or two away from being another Italy. If that happens, all bets are off.
And so I think that dovetails into another question that I think I've heard a lot of economists, a lot of analysts pose just today alone, and that is with the recent move by the Fed cutting rates to where they're at. The next question starts to become, are we going to move in that direction similar to the EU and start seeing negative rates? Is that something you expect to see here anytime soon, or do you think we're going to maintain positive rates here, at least for the foreseeable future?
I don't expect to see negative rates, because you literally crush the economic potential of a country when you go to negative rates. There will be no more growth, and we will officially be in a trend market from that standpoint. Lots of peaks and valleys, but basically a flat line over the long term. So hopefully rates won't go there. But the disappointing thing is the Fed did an emergency rate cut, the biggest one in history, on a Sunday, with the largest stimulus announcement in history on a Sunday, and the market is down 7.5%. So what does that tell you? That tells you that the market is pricing in other things, and the Fed's actions are relatively benign because they're not going to be able to get people to go out of their house and make purchases and spend money. Based on the limited mitigation areas that we have in the country, Miami, Fort Lauderdale's on lockdown, Ohio schools, Washington schools, Massachusetts schools, Florida schools, all these schools are on lockdown. People aren't going to be spending money on anything other than taking care of their family at this stage. And until that consumer pattern changes, we're not going to see the markets come back or the economy potentially come back. So right now, This is something we've never faced before.
All right, we're going to have to leave it there. Thanks a lot, Jeff. That was Jeff Small, President, Arbor Financial Group.